Shock headline out of Japan, which shook up the entire financial world. The Bank of Japan, for the first time ever, is going to be selling its stocks. According to these reports, Japanese officials are becoming ultra serious about their CPI problem to the extent they're willing to sacrifice stocks in the process. It sounds huge. And in the short run, the trick worked. It did provoke a sell-off in stocks and bonds. And yes, this is a trick. Now, if you've already seen some of the details from the Bank of Japan's latest meeting, which is held Friday morning in Tokyo time, you've probably already got the sense that what I just said is exactly the right characterization. To begin with, for all the hubbub over stock selling, Bank of Japan did not raise its benchmark policy rate, which sits at a gargantuan 0.5%. No, you didn't hear me wrong there either. 0.5%. Not 4.5%, not 2.5%, just 50 basis points, where it has been since January. Yes, January. The Bank of Japan has been on hold for 8 months already and just voted to stay that way at least for another month or so. Obviously, then, there's a lot more going on here than just the Japanese central bank selling its stocks and provoking a backlash across the marketplace. This is a trick. And to understand why, you have to appreciate the intersection between politics and central bank versions of economics and how the Japanese households are caught in between everything and forgot how to grow. That's where all of this comes from. That's the dynamic at play. And the Japanese are as much forgetting about everything as everyone else. And on top of all that, there's no inflation anywhere in this story. But early Friday morning Tokyo time, the Bank of Japan decided to keep its benchmark policy rate on hold again, as I just said. The central bank has been stuck at 0.5%, not exactly a huge rate, for 8 months running since last raising its target back in late January. And why has the bank been on hold with its benchmark rate policy? Well, the economy in Japan has become, to use the word they always use, highly uncertain. What that term means is simply the economy isn't actually performing the way everyone expected. In Japan, it's supposed to be picking up again when, well, it's not. Even if second quarter GDP surprised to the upside. And as far as GDP goes, temporary doesn't even begin to describe it. So the whole point behind rate hikes, in theory, is to slow the economy in order to reduce inflationary pressures. Now, that's not how inflation works to begin with. But what if the economy isn't fast or even stable? Japan's economy is neither of those, not even close. But none of this actually matters. What does, as far as the central bank practice of economics, is psychology, because these aren't actually central banks. They put on a performance, a puppet show, in order to get real economy and financial market participants to behave in a way that officials and economists believe will be able to achieve what they call optimal outcomes. It's all a puppet show. If you think inflationary, you'll be inflationary. And the reason you might think inflationary doesn't even matter, at least according to these mainstream economics. It's just floating around out there in the ether of social media. So to counteract this, the central bank will use all of its powers of persuasion, not money, mind you, persuasion, to create the impression it is doing something about this floating ethereal inflation. We're told that means rate hikes, but that can also include other kinds of quote-unquote restrictive policies. They even call these policies restrictive when no one, and I mean no one, ever bothers to ask whether they are or not. The media just labels them either ultra loose when it's QE or QQE in Japan's case, or highly restrictive, and these narratives feed the psychology. At least that's what they're supposed to do. And that's exactly why the Bank of Japan shocked everyone Friday morning, announcing it was going to be selling stocks. The whole point was to use that shock and get the media to blare headlines all over the country and the world to ignite social media at how restrictive the Japanese are beginning to be. No one expected this to happen. It's an announcement effect. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video. And now let's get back to it. As Bloomberg wrote, the central bank announced Friday it will start selling its well over 75 trillion stockpile of ETFs by market value at a pace of about 620 billion yen per year. While at that rate it would take more than a century to sell, stocks fell as it marked the first time the BOJ has laid out a plan for offloading the assets it has accumulated over years of, and here they go, ultra easy monetary policy. They make these labels whether or not the evidence shows anything was eased. QQE was a dozen years ago. And then the 7 years between the start of it and the COVID showing up in 2020, there was zero hint of anything becoming easy. No inflation, no recovery, no nothing. Just more of the same constant psychology. Those policies didn't suddenly create a new Japan in the 2020s either. What happened was simply the post-pandemic world that got distorted and screwed up everything in the process, and now everyone has to pay the price for all those distortions. Simple economics, small e, not capital E. And those distortions are in Japan's CPI right now, even if it has nothing to do with actual inflation, as we'll see in just a moment. But going back to the Bloomberg article, sales of these ETFs, not even stocks, it's just ETFs, they would begin early next year, so it's not like they're in any kind of hurry. Kazuo Ueda even said, "We won't be here in 100 years' time, but our intention is to keep selling for more than 100 years. In other words, these central bankers are going to be selling a tiny amount of their ETFs. So tiny, our great-grandchildren and great-great-grandchildren are still supposed to be sitting around talking about this in 2150. It's hardly earth-shattering, is it? But it did accomplish its goal. To further the impression the Bank of Japan is taking inflation seriously and diving into its toolkit as necessary to tackle a problem Japan doesn't actually have. It's all a performance to get voters primarily to believe in it, to believe that their government working through the central bank is acting in a way and forcefully in a way that's going to fix the problem that voters, as consumers, as households, as workers feel is really leaving them farther and farther behind, because that part of it is absolutely true. And as we've seen in so many places around the world, voters are taking their anger out on governments. And that kind of political pressure extended into BOJ's boardroom too. The vote to keep the overnight rate at 0.5% was only 7-2. This was the first vote under Kazuo Ueda where there were 2 dissenters. So you can see what happened here. Ueda had to do something, anything, to appear to be fighting inflation Japan does not have. Japan has a consumer price and CPI problem, but neither of those are actually inflation. Japan's economy is anything but inflationary, as incomes and spending are down, exports are falling, and the whole thing is still teetering on the edge of recession after having never recovered in between the last recession just a couple years ago. But CPIs remain high, and the Japanese people are angry as hell about it, as they should be. But BOJ won't hike rates because they're afraid another quarter point might somehow push the weak, not inflationary economy over the edge into outright unmistakable recession. But as I said, the political pressure to appear to be doing something about inflation, it's just too great to do nothing. So they came up with this idea to shock the markets by announcing they're going to be selling stocks for the first time ever. And the trick worked, at least in the short run. Even though in reality, they're only selling ETFs, and in such a small amount, no one would ever even know it was taking place if they didn't make such a huge deal out of it. Do you see it now? This is all just performance. The idea is to create waves in the media, to create psychology, to create the belief the Bank of Japan is doing something shocking about its inflation problem. That's what this is. It's all just a puppet show. Even Japan's bond market has taken a break from rate hiking BOJ driven inflation fear. Everyone has been shouting about ultra long dated JGBs, in particular, how the bond route in them is proof the world is rejecting government assets or something along those lines. Along with the 30-year UK gilt and the US Treasury long bond, these far down the curve assets are supposed to be the canary in the coal mine for bond vigilantism or heavy, structural inflation risk or whatever narrative that clearly isn't being priced on the rest of these curves. In fact, the Treasury long bond has already taken itself out of that narrative. But even JGBs aren't really playing along either, which is weird because the BOJ is performing its theater in part to get the government market to dance to its tune. Japan's 20 and 30-year maturities have been relatively steady from around May 20th, which is a date that keeps coming up all over the financial marketplace, the globally synchronized financial marketplace, even where it doesn't immediately appear to be globally synchronized. For example, the 10-year US Treasury hit its most recent high, its post-April high, on May 21st. The 30-year long bond was 5.08% on that date. Now, both have been sliding lower ever since, with renewed pessimism over the state of the global economy, driving demand for longer run safety and liquidity, even longer run safety and liquidity, not fears over inflation and government deficits. And JGBs as a whole have been doing the same thing, despite upward pressure from the Bank of Japan's, their jawboning. The 10-year JGB hit nearly 1.6% in late March, but as of today, it's only a couple basis points above that rate, meaning generally sideways over the last 6 months, while bond markets around the world have been bull steepening. Japan's 5-year government bond was just shy of 1.2% back in late March and is today slightly below that rate. When you put those together with the relative stability at the long end, with relative being the key term here, and the fact that short-term rates like the 2-year are still rising from BOJ pressures that are the fact that it's still going to hike rates at some point, Japan's curve is behaving throughout 2025 far more consistently with the rest of the world than anybody seems to appreciate. That is, mid to long rates that aren't rising for the same reasons that mid to long rates almost everywhere else are going down. Even the mainstream sources are starting to see the curtain pulled back, as Bloomberg reported on Friday. The bearish sentiment that has made global longer maturity sovereign bonds among the worst performing fixed income assets this year may be about to wane, making the securities a buy, according to T.S. Lombard. Fixes are on the way as governments from Japan to the UK are already trying to better align demand and supply of long bonds to bolster the securities, and they're also planning buybacks, said an economist at the research firm in London. But no, it's not the fixes. It's these global conditions. Bearish sentiment is sweeping the world's curves, and JGBs, despite BOJ's performances, are joining in with them. The only part that's missing right now is the big Japanese financials. But many of them, as I've already pointed out, they've already stated that once they get some idea when the BOJ will finally have to draw the curtain down on its inflation performance, they're going to stampede right back into long bonds, most of all because the rates that they're now yielding. Remove the BOJ instability, and those things are huge buys, especially for a world that is heading in this direction, the direction that we see in the US labor market. That's what the curves are all pricing, including JGBs, even in the face of the Bank of Japan's hawkishness. As far as Japanese consumer prices, Japan has a massive rice problem on its hand, not an inflation problem. Rice has exploded and energy's become very expensive too, but neither of those have a root in the economy itself. The biggest threat is actually a heat wave which hammered rice harvests back in 2023. That's right, the greatest source of Japanese quote-unquote inflation is extreme weather from 2 years ago. The quality of the crops has been a big problem ever since then, and a lot of production was destroyed and is yet to come back. So the Japanese government has been parceling out rice from its own reserves, but apparently those are almost gone, which is helping trigger panic buying and keeping stubborn prices stubbornly high. One farmer told Nikkei Asia this summer that, quote, if we have no reserves left, meaning government reserves, and the quality of rice has deteriorated due to extreme heat, Japan may have to import a considerable amount. The food problem is not just a problem for farmers, but a problem for everyone who eats. What the hell are rate hikes and selling stocks going to do about this rice problem that is the key component in keeping CPIs high? It's not going to do anything. But if you think it might help in some way for an inflation problem, then that's what the government is really after, using central bankers to accomplish it. But if you take out food and fuel prices from the CPI, there's nothing but steady price changes. And I mean steady, remarkably steady. That part of the index has been rising at about 1.6% year over year for each of the last 6 months through August, safely below the Bank of Japan's so-called inflation target. In fact, it has been right around 1.6 to 1.7% ever since the global inflection in May 2024, which is not an accident. Yet, the Bank of Japan persists with inflation theater anyway because of politics, not economics. And then you go from there, look around the rest of the Japanese economy, and it only gets uglier, especially where it gets to households. But before we get to the households, Japan Inc. in its export situation, not having a great time post-tariffs. Japanese exports are now declining in both nominal and real terms. Adjusting for prices and currency changes, export volumes in August 2025 were down nearly 4% compared to August of 2024. And given the tariff situation, exports to Japan's chief customer, the United States, they have started to outright crash. In nominal yen terms, exports to the U.S. were down 13.8% year over year last month, with a ghastly 12% year over year plunge in trade volumes, again, just with the United States. And that's not all. Japan saw a similar volume decline in exports to China in August as well. We talked about the second half rebound across the global economy that's quickly becoming second half deterioration. That's already showing up in Japanese statistics, and it's going to be a huge factor in Japan's economy. One reason why the Bank of Japan, for all of this inflation fighting expectations and psychology, did not raise their short-term benchmark rate here in September. But the big one, though, Japanese households. Japanese households who contain a lot of Japanese voters. Household spending has been subdued this year already. Apart from a flurry of car buying back in May as Japanese consumers freaked out over tariffs and trade wars, spending has continued to be relatively dismal. It looks decent in nominal terms, or it did before the payback in June, but as you can quite clearly see, and this chart leaves you no doubt about why the Bank of Japan is performing the way it is, Japanese are paying a lot more to get quite a lot less. This is the same post-pandemic economic formula which has gotten government after government thrown out of office. Doesn't matter where or what partisan affiliations, all consumers know around the world is that they've been paying a lot more, and in many places like Japan, they're getting a ton less for doing so. So not surprisingly, the income data matches the spending data. Nominal incomes are rising, but it's not nearly enough to keep up with prices, especially prices for necessities like food. And you wonder why these people are so damn angry. They're angry because they don't get answers and nothing changes. All they hear is, we've got it covered and the economy is solid and strong and resilient. So ask yourself, assuming all these central bank policies really are restrictive and they really do what they say they do, how in the hell would restraining the economy help the situation in Japan? If the restraining interest rates and selling stocks and all that stuff, if that actually worked, the nominal incomes would stop rising at the same rates, meaning Japanese would fall further and further behind in incomes because not even their nominal incomes would be growing at the same pace or even growing at all. So that wouldn't cure inflation or quote unquote inflation because price changes are being driven by supply factors, especially where it comes to rice and food. Now, on some level, even those at the Bank of Japan know it, which is why they didn't want to raise rates, and they haven't since all the way back in January. For a government and a central bank that is supposed to be grappling with this immense inflation problem, they actually don't seem to be doing a whole lot about it, apart from the occasional headline. But, and you know this, they're political masters. These political masters of their beleaguered government, which keeps suffering electoral defeat after electoral defeat in Japan, it absolutely demands some kind of performance to at least be able to say to the voters, they're doing something big about the worsening plight of the Japanese people who are simply getting the short end of the global economic stick which was shortened dramatically by the fact the world never recovered from the lockdowns and the global supply shock, price illusion. It all comes back to that same thing. They've been saying recovery, everything's fine, we've got it covered, and people all around the world know that is all just plain crap. So do you see it now? Now, China is a perfect example of quote-unquote stimulus and how it doesn't actually stimulate, especially from the fiscal side. Here we have Japan, which is pulling back the curtain all the way back on this absurd central bank theater. Japan's economy is in no way inflationary, and the JGB market knows it. But the JGB market also knows the political calculations going on here. So the possibility of further rate hikes has created uncertainty that leads to volatility, which up until the last 6 months had propelled yields upward, especially at the long end, which is consistent with what we're seeing around bond markets everywhere else. It was never bond market rejection of debt issuance or anything of the sort. It's instead the fact that central banks are the greatest source of uncertainty across the entire financial world. Households in Japan are getting pummeled and left farther and farther behind. That's what the data shows, and shows it conclusively. That's what the voting patterns show, and shows it conclusively. And that's simultaneously the basis for Japan's ongoing economic weakness, and ultimately why the Bank of Japan feels it has to carry out this nonsense about trying to restrain an economy that otherwise needs nothing like restraint. If they really thought the Japanese economy was truly inflationary, the Bank of Japan would be raising rates, and not just here in September, they would have been raising them all year. But they know it isn't, and that the situation is precarious at best. So no rate hike here in September, but they needed to do something, anything which might sound hawkish. So they got their headlines screaming about how the Bank of Japan is going to be selling stocks for the first time ever. Even though at such an infinitesimally small rate, no one would otherwise notice. Narrative, reality. And it's not just about central bank policies, it's also about what's happening across the global economy. But then again, there are periods where narrative meets reality, and that's the position the Federal Reserve finds itself in, and the fiasco of a debacle of their FOMC meeting. All of the details in the replay of the live stream linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.